SolarEdge announced a major layoff on Monday morning, and I think this is actually an example of a really bad layoff. If you're looking at clues for what a company is doing, how operations are going, what they're doing to manage costs, I think this is actually SolarEdge admitting that their business is in a little bit of trouble. Now, I don't want to go too far with this because we don't know exactly what fourth quarter earnings are going to look like. The industry is in a down point. We've seen that from everybody from SolarEdge to Nphase Energy, which are the companies that are providing components into the industry, to installers like Sunnova, SunPower, and Sunrun. But I think this one is a little bit different because of some of the clues that we got earlier in third quarter, not only results, but also guidance for the fourth quarter. So I'm going to dig into all of this today and hopefully give a little bit of context and why I think this might mean that SolarEdge is falling behind in the industry. My name's Travis Hoium. Thanks for watching Asymmetric Investing, and please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they give you their top 10 stocks to buy right now. Now let's just go to the announcement because I think that's a great place to start. And I'll give a little bit more context a little bit later on. This is the announcement that SolarEdge put out this morning. The press release said that they're going to reduce workforce by 16% of the global workforce. But the details behind it are really where investors should be paying attention. So this is approximately 900 employees. And this is the thing that jumped out to me right away. 500 of those employees are at various manufacturing sites. Now, if a company is reducing operating costs, reducing sales and marketing, general and administrative, that is one thing. When a company starts reducing manufacturing expenses and employees, that means that you're going to be making fewer products. So this means that demand for their products is fundamentally lower than it was previously. That is the big concern, is that this is maybe going to be something that is going to last a lot longer than a lot of investors thought. I think based on the information that we've gotten from the industry, it's likely that sometime in mid-2024, we're going to start to see some sort of recovery in residential solar installations. But apparently SolarEdge thinks that this slowdown is going to at least last a while. Maybe they can get a little bit more efficient, but these costs, you don't lay off people and then just simply hire them back 3 months later. So they think that this is going to last a while. So that's really notable. The other thing is some of these changes are going to be more structural. They're discontinuing their manufacturing in Mexico and reducing manufacturing capacity in China, and then terminating development of a light commercial vehicle e-mobility activity. I think that was kind of a distraction for the company, to be fair. So I'm not worried about that last piece, but the first two, discontinuing manufacturing in Mexico and then cutting jobs in China, I think are really notable because this has been where a lot of supply has come from. Now, a lot of that supply is probably going to move to the US. That's where there's a lot of subsidies. So there's probably reasons behind these moves specifically, but this is a major layoff and over half of the employers are coming from manufacturing. So I think that's really notable and actually very concerning for the company's demand. And that's where we go back to the third quarter numbers and the guidance for fourth quarter, which at least put alarm bells off in my head. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Let's go to the third quarter presentation because there's a number of things that are just heading in the wrong direction for SolarEdge. This is the shipments. This is power optimizers and inverters. You can see that this power optimizer shipments number has been trending lower for 3 quarters now, and that's expected to be even worse in the fourth quarter of 2023. Inverters also starting to go negative. Revenue did start to go negative. Now, remember this number right here, $991.3 million in revenue in the second quarter, because that's going to drop dramatically by the fourth quarter of 2023. But we're also seeing margins come down. Start with gross margins. Gross margins fell from this low 30% range to under 20%. Even on a non-GAAP basis, they were down about 12 percentage points to 20.8%. So that's a really big drop in gross margins. Go down to operating margins, and now you start to get to a negative point. SolarEdge is generating a negative operating profit on a GAAP basis, barely profitable on a non-GAAP basis, but that probably won't be the case in the fourth quarter because we get to guidance, and now you see how bad the numbers are going to be for the fourth quarter. Remember that $991 million in revenue for the second quarter of 2023? That's going to be down to $300 to $350 million in revenue. Could be a 2/3 drop in revenue in just 2 quarters. So the trends for the business are just terrible right now. This is why you start to see them have to have these cost cuts. Margins are also expected to be really poor, 5 to 8% on a non-GAAP gross margin basis, including a 130 basis point benefit from IRA manufacturing tax credits. Add in these operating expenses, and we're going to have another operating loss and probably lose money in the fourth quarter. So that is really bad. But what's worse is when you compare it to what Nphase Energy sees. This is Nphase Energy's result. And I'm going to focus on the non-GAAP numbers right over here. This is the second quarter. $711 million in revenue. Remember that number because not as high as SolarEdge was at 991, but gross margins are much higher, 46.2%. Third quarter of 2023 revenue falls to 551 million, but margins stay up. Margins stay elevated, actually increase to 48.4%. There is benefit from those tax credits and the subsidies that the United States has put into place. But what we're looking for as investors is who's actually making the most money. And it's clear that Nphase is making better gross margins. If you go down to guidance, we see that Nphase also sees a drop in demand, but not going to be the same drop because they're going to be now in about the same range of revenue, $300 to $350 million in revenue. But what happens to margins? Remember, SolarEdge is expecting the non-GAAP gross margin to be 5 to 8%. Well, Nphase is expecting non-GAAP gross margin to be 48 to 51%. So there's much more pricing power for Nphase Energy than there is for SolarEdge. This is becoming really clear. And when you start to see these cost cuts, what appears to be happening is that the demand is falling off for SolarEdge first, and it's not falling off for Nphase in the same way. They're able to keep their prices where they are. Management has said that they haven't been forced to kind of concede on prices yet. We'll see if that maintains after fourth quarter results are released and we start to hear some commentary about where 2024 is going to go. But based on these numbers and based on the layoffs at SolarEdge, it appears that SolarEdge is definitely losing market power to Nphase Energy. We'll learn a lot once we get to fourth quarter results and conference calls, but I think based on what we've seen so far in the third quarter results and the guidance for the fourth quarter, and now this layoffs, I think investors should be much more concerned about SolarEdge than they are about Nphase Energy right now. And what I'm going to be looking for is, are we seeing the market move to one side, to Nphase being really the power player? And if this is no longer a duopoly, where both of these companies have more or less 50-50 market share in the module level power electronics business, and we start to see Nphase exert more of that power and have more market share, that's going to be a really interesting place to be, because this may be the one profit driver for the industry long term that's really sustainable. That's why it took so much away from this announcement for SolarEdge. There are good layoffs for companies, there are bad layoffs for companies. I think a lot of companies, especially in the tech industry, have taken the last couple of years to reduce their operating expenses, maybe spend less money on sales and marketing or general and administrative in places where there's not necessarily a direct payoff, where maybe costs have gotten a little bit too bloated, but they're not impacting what they're doing in their fundamental business. Most of these companies aren't reducing the number of engineers who are building new products and things like that. What I'm seeing with SolarEdge is you're seeing something very different. You're seeing over half of these layoffs be the people who are actually making their products, physically producing their products, and especially in these lower cost countries like Mexico and China. So that should be taken a little bit differently than a company that's just reducing some of their overhead, because this is far more than that for SolarEdge. And that's why I'm starting to read into these numbers from last quarter and the guidance for the fourth quarter a little bit more. We will see if what I think seems to be happening is confirmed with those fourth quarter numbers and guidance for first quarter and then full year 2024. But a lot to dig into here. What do you think about the recent layoffs at SolarEdge? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.